even though we are seeing defaults pick back up, even though things are slowing, albeit perhaps not, a crash and burn recession. How do you make sense of this?
Well, everything's rallying across most markets. I think that's how you make sense of it, right? The high-yield credit market, for example, which you're referencing, is rallying just like everything else, and it's hard not for the rising tide to lift all ships. That being said, when you have high-yield spreads, I'm sure you guys can pull up the Bloomberg index, getting inside of 400, that's well inside of average levels, and it does feel probably tighter than you can justify if you kind of think about medium-term fundamentals and everything going on in markets, and especially default rates, right? We still think this year in high yield, you'll probably see a 3 to 4% default rate. You'd expect a little extra premium as a result of that. Is the mismatch, really large? No, but would we feel a lot better if it was 100 basis points wider? Yeah, we probably would.
Kelsey Barrow of JP Morgan Asset Management was on earlier, and I said, if credit's a leading indicator, it's suggesting that there's not going to be a significant default cycle, and it suggests that the rally that we're seeing in equities is entirely justified. She said it's not a leading indicator. Is credit no longer the smart money?
So, look, I think each cycle's different, and that's what we're learning, right? And so credit was certainly the leading indicator if we go back to a period like 2008 and the financial crisis. But things are quite a bit different this time. And think about the most recent episode we had around regional banks and the like. Well, what happened? We came up with some rules that worked really well versus the 2008 crisis when it was an asset quality problem. But what did you do to kind of deal with those rules if you're a bank? Well, you bought out the curve because the curve was upward sloping at the time. And so I do think you have to take a step back and say, okay, well, maybe this crisis isn't going to be like the next one if you're looking for that next episode. And then the last thing I would say is that the high yield market specifically has gotten a bit higher quality than it was historically because there have been alternative avenues of financing. And as a result, maybe that's not the exact place to look.
I look at, and I want to make this clear, folks, that Brad Rogoff's royalty here, popping from Lehman to Barclays, and we're trying to get him over to Bloomberg here as we move the indexes that we all follow over. You bring up the Lehman Total Return Index, now the Bloomberg Total Corporate Index as well, and it's basically a linear regression, straight up, everything's wonderful, off a cliff, and then I'm going to call it a dead cat bounce. What are the ramifications if we do get price down, yield up in corporate paper?
Yeah, and I think the reason we had that kind of fall off a cliff that you just alluded to, a lot of that is when you think about corporates in general, especially investment grade corporates, for example, the duration is significant and longer than actually the average duration, say, on treasuries, right? And as a result, when you have a huge increase in interest rates, that you can have pretty bad total returns. Now, that doesn't mean actually the credit spread component is problematic. And as Lisa was just alluding to, and Tom, you were originally, that's come in quite a bit. So I think what the ramifications are right here is that yields actually look pretty attractive on a lot of these assets. So you were talking about high yield. Well, the spread is well below average, and in fact, around 400 spread. If you look at returns going forward, it tends to be mediocre, honestly. But if you look at 8 to 9% kind of yield, which is the range that we've been in for yield, those returns tend to look pretty good. So I think the one thing you have to factor in is because of the move, and Tom's alluding to it with those total returns, you've got margin for error right now in total returns in credit markets.